Well, good morning, good afternoon, and welcome to another episode of Meet the Expert. I'm Elliot Kallen, CEO of Prosperity Financial Group, and I want to welcome you to this terrific episode. Today we're going to be talking about a subject that most people never talk about, municipal bonds. Something that maybe some of us dream about in the middle of the night. Most of us forget it. We can think of more exciting ideas than municipal bonds. But it's important because it's about tax-free investing. And there are clients out there who this is a big issue, and paying taxes is such a sore spot that they want to lower their taxable income and still walk away with enough money for themselves. So I want to welcome Nicholas Henry. He's the portfolio manager in the Muni Bond Fund. Muni is short for municipal, of Invesco, a very large organization. And we're going to talk about municipal. So Nick, welcome.
Thanks, Elliot. Good to be here.
Glad to have you, sir. So let me ask you a few questions, if I may. And we're going to, as we talk about this, what is a muni bond fund versus a muni bond? And how does that differ from, let's call it a treasury or a corporate bond?
Sure. So, the municipal bond marketplace is a unique asset class and marketplace in a lot of ways. And so what I mean by that is, unlike treasuries or corporates, for example, muni market is over-the-counter traded, which means that in order to be able to buy some bonds that exist, somebody specifically has to be selling them. There's no sort of bond tree out there that you can go on a given day and pick whatever bonds you want. So that's one thing that makes the trading aspect of the market a little unique. The other thing to keep in mind, though, with munis is that it's heavily retail-driven marketplace, where the treasury market or the corporate fixed income market or even the sovereign fixed income markets all have major influence from the institutional buyers. The muni bond marketplace is 75% driven by U.S. retail mom and pop investors just like you and me, right? And so whether they're owning individual bonds or shares of a pooled investment of some kind or another, the retail buyer drives pricing in the muni market on a daily basis. And so what that means is, unlike the other asset classes, if mom and pop, if we get excited about munis and start buying bonds for any reason, whether it's a good reason based on analysis and fundamentals and all this other things, or a not good reason based on something we heard somewhere that we didn't even verify whether or not it was accurate. If we start buying bonds, bond prices in the muni market go up, period. And the inverse is also true, Elliot. So if we start selling bonds, if we get upset about the asset class for, again, any reason, good or bad, and start selling bonds, bond prices go down. So the muni marketplace does not have as much liquidity in general. It's not as free-flowing, not as much trading as in the treasury or the corporate marketplace. And in a lot of ways, we see a lot of weird things going on in the muni market that you just don't see in those other asset classes. And the reason why, in brief, is that if you think about it, muni bonds are issued by state and local governments across the country. Right. Well, state and local governments are run by politicians, right? Elected officials. And how many politicians do you know who are also CPAs, right? If you're like me, the number is very few. So my point is, politicians are pretty good at raising money, really good at spending money, but maybe not so good at balancing the books. That's not necessarily their core competency. So we see a lot of bizarre things in the muni market that allows investors like us to take advantage of, and therefore clip a lot more return in the form of tax-free yield, like you mentioned earlier, for the initial amount of risk that we may have to take to get that return.
Okay, so we live here in California, and California is obviously a silly tax state with 11 to 13%. There are people listening to this in New Jersey and New York that aren't feeling good either. And then, of course, there's Texas and Florida and some other states that are just laughing at us. What is the difference between buying a California municipal bond or bond fund, as you do it, and a national bond fund?
Well, the biggest difference is, so a national fund versus a state-specific fund. National fund, so muni bonds, the big benefit to muni bonds to an investor is that the interest income that these bonds give off, that they pay out, is tax exempt. You do not have to pay income taxes on the income from muni bonds in general. Technically, there are some taxable muni bonds, but that's a very small percentage of the market. And most of what we're talking about here today, and in general, when you talk about munis, you're talking about tax exempt or tax-free muni bonds. So with a national muni fund or a bond in general outside of your state, you're generally, what you're saying is you will not have to pay federal income taxes on the interest income you receive from that bond. If you invest in a bond within your state, typically speaking, if you're a state that has a state income tax like California, New York, New Jersey, so if you invest in a bond, if you're a California resident and you invest in a California state issued bond or a bond issued within a California state, generally speaking, you will not have to pay state and federal income taxes on that interest income. So that's the difference between a federal bond or fund and a state-specific bond or fund, is the potential for additional state-level tax exemption on top of the federal tax exemption that you would also get.
So Nick, why in California would a resident ever buy a national muni fund, national muni product, rather than just California?
So the reason, the biggest reasons why would be diversification, right? It is possible, Elliot, that there are times in the market and, the cycle of where California bond yields are versus, other bonds around the country's yields are, or perhaps California's bonds might yield a little less than other areas. So sometimes you might be able to make a yield-based argument for why, as a Cal investor, you might want a national fund. But typically that's not the case, specifically with Cal, because Cal tends to pay a little bit more in yield to borrow than other state localities around the country. So the biggest reason would be diversification. And then if you can arbitrage your specific tax situation against the having to pay the sort of local or state tax on, New York bonds or Jersey bonds or whatever, if you're a California resident, then perhaps that works out, at least doesn't penalize you in that way. But diversification would be the biggest reason.
Okay. And what's the difference, Nick, between a municipal bond fund and just somebody buying laddered bond portfolio?
Well, again, the first big difference is going to be diversification, right? So laddered bond portfolios, you might have 15, 20, 25 different bonds in a laddered portfolio, and that's all well and good, nothing wrong with that. But in a fund, it's not uncommon in larger municipal bond funds, whether they're, regardless of who's managing them, to see 1,000, 2,000 different holdings. And so, as I mentioned before, with a lot of weird little things going on in the muni bond market, being able to not have to stock up on or have an outsized exposure to one thing that then may run, gets a little silly sometimes. That's where that diversification will help you, is by spreading out that risk a little bit. Now, that is somewhat mitigated by the fact that when typically in laddered portfolios, people don't take on too much credit risk. So what I mean by that is there is a credit rating scale. Everybody's heard of AAA rated things, right? Bonds or what have you, or funds or states or whatever. And that's not unlike a personal credit score, right? So the higher your credit score is, the better a borrower you are judged to be, and therefore, ideally, the less you would have to pay less in interest to borrow money than somebody who had a lower credit score than you. Well, that is also true with the credit rating scale that exists in this case for bonds or for bond issuers, which is that the higher the rating, the less you would have to pay in interest. That's why you want a higher rating. That's why you want to take care of your rating/credit score. So typically speaking, in a ladder investment, you're going to stick to the higher credit rating areas. And you'll pay for that by not getting as much income maybe, but you're not going to take on that risk of volatility that you also assume when you buy lower rated bonds. So again, if you want more yield, maybe the fund is going to be a better scenario, because managers have the flexibility through that diversification to add some yield by going a little lower in credit with part of the portfolio and countering the effects of that volatility by having some in the higher grade part of the market in other parts of the portfolio.
Nick, can we lose money? Can a client lose money?
Absolutely. These are not money market funds. They're not CDs. They're not stable value funds. I don't even know if those are still a thing, stable value funds. But yeah, there is no guarantee that there's no guarantee that this investment will make money. But let's think about that from a practical standpoint, Elliot. It's a really interesting discussion when it comes to munis, because typically speaking, muni bonds have a very low default rate. And what I mean by default rate is, we're talking about the chances or the instances of muni bonds that do not do what they're supposed to do over the course of their entire life. And over the course of a bond's entire life, what it's supposed to do is pay you the coupon rate, the interest that you sign up for on a annual or semi-annual basis most of the time. And at the end of the bond's life, theoretically, it's supposed to give you back the principal at your par amount, or 100 cents on the dollar. So a bond is just a loan, right? It's just a loan. And there's two parts to a loan. There's the principal and the interest. So if I loan Elliot $1 at 5% interest for 1 minute, I'm hoping that in a minute, you give me back my dollar plus my 5% interest, my nickel in this case, right? So if you think about it from an investment standpoint, if I, on the principal side of that loan, if I start with $1 and end with $1, I made no money, 0% total return on the principal. That means that 100% of my total return was that interest rate that I charged Elliot for the length of the loan, right? That 5%. So typically muni bonds, and I'm talking about high 90% of the time, end up throughout their entire life paying you back all of your principal at par plus your interest, high 90% of the time, and more often than corporate bonds on average. It's not 100% of the time, like I said, but it is more often than corporate bonds. So in that scenario, it is considered a more stable asset class, arguably, than corporate bonds. Maybe not as stable as treasury bonds most of the time. But so we are talking about degrees of safety. But yes, there is no guarantee that you will make all your money back in any investment, but specifically in muni bonds.
Okay, and then before we wrap it up, I want to throw some politics into here because, right now, Portland is being torn apart. New York City is being torn apart, and the New York Post this morning came out with the headline that New York City is the worst retail market of any major city in the United States. So New York City issues bonds. Chicago is a mess, and they're issuing bonds, tax-free bonds. Portland and Oregon are issuing tax-free bonds, and these could be in clients' portfolios. And there's no doubt about it that revenue is going to drop precipitously. So what happens to these bonds?
So this is the risk right now in the muni bond market that managers like us are grappling with, how to evaluate the potential impact of that risk. And a lot of that, of course, is going to be determined by how long either the quarantine lasts or the civic unrest lasts, or both, right? Depending on where you are. So, and we don't have all those inputs yet. So it's still sort of an open-ended problem, right? But undeniably, it is a concern, and it's something that we are all trying to wrap our arms around and figure out the best way to model for that risk. The thing I think, Elliot, that's really important though to keep in mind, there's two things. First is sort of conceptual, and the other one's more structural. The conceptual thing that I think that people have to understand is that the majority of muni bonds are supportive of infrastructure and commerce at the state and local level. So muni bonds are your water utility, your electric utility, highway building, schools, toll roads, things like that, right? And so from a pandemic, quarantine, or civic unrest standpoint, the risk only exists as long as those things are issues. And again, I don't know how long those will continue to be issues, but I do think that those are going to not be permanently part of reality, right? I think they are a temporary thing as far as impact to sort of commerce and the economy. So in the meantime, during the shortfall of revenue that's creating in the short term, what states and local governments need is bridge financing. And by and large, we're getting that from the federal government. Everybody's heard about the CARES Act, the $2 trillion stimulus package we got from Congress and the president earlier this year. We're working on it. There was money in the CARES Act, several hundreds of millions of dollars, or billions of dollars set aside that directly helps municipal governments, airports, hospitals, higher education, things like that. They're debating another bill right now that would add more billions of dollars of aid to state and local governments that's being bandied about in Congress as we speak. So we are seeing that bridge financing being made available. Now, of course, there's no free lunch. As you know, Elliot, all the money the federal and or state and local governments give out right now is going to be recouped eventually. And typically that looks like higher taxes, right? So get ready for that. That's going to be a lot of fun. But the point is, in the short term, as far as staving off distress at the muni bond level, we're seeing those short-term bridge financing options be made available. And the second thing and last thing is that is looking at the numbers, right? So I looked at, you mentioned New York City. I looked at, for last fiscal year, what percentage of New York City's GDP came from tax revenue from a combination of the arts, entertainment, recreation, restaurants, and hotels sectors, right? Arts, entertainment, recreation, restaurants, and hotels. And the number was 4.6%. So for the last fiscal year, New York City relied on arts, entertainment, people going out to eat, people seeing shows, people staying in hotels, what have you, right? Relied on that to the tune of 4.6% of its budget. That is not zero, but it's not an insurmountable number either. And I will tell you that across the country, whether we're talking about New York, Illinois, California, Oregon, what have you, numbers are similar. Low single-digit percentages of GDPs represented by people being out there living our lives. So not minimizing the risk. I'm just saying that in context of reality, these are not numbers that, okay, so even if we lose, you don't want to lose any, but let's say we lose 4.6% of our revenue from last year, which it's not going to be all, you're not going to lose all of it, but you lose 4.6%. Does that represent New York City going belly up? Not really. So we're going to see some more volatility here as we iron all this out, I think, in the high yield part of the muni market. But in general, the majority of the muni market is going to be A-OK coming out of this period.
Great, Nick. I consider us, since we are fiduciary advisors, I consider muni bonds, muni bond funds, and what you do at Invesco to be tools in our toolbox. For the right clients, they're perfect. So we've been talking with Nick Henry here from Invesco, who runs a muni bond fund at Invesco. Thank you very much, Nick. If you have questions and want to reach out to me, my email is Elliot, ELLIOT, @prosperity, F as financial, G like group.com, or www.prosperityfg.com. So you've been listening to an episode of Meet the Expert. We thank you, Nick, for being part of us today. Thank you for the folks at Invesco, and we look forward to seeing you again. Have a great day.